Okay, so today we're gonna talk about intra-group transfers for consolidation entries. And this is for intra-group transfers during the same period. So for this example, you can see that in 2019, S transfers inventory to P at a transfer price of $10,000 and the original cost was at $7,000. Now, we don't know which is a sub of which, so we don't know which is the investor, which is the acquiree, but we will assume that both companies are in the same group. Okay, so at this point in time, we don't need to distinguish between which is the parent and which is the sub. So moving on, we see that in 2019, 60% was resold by P to third parties. So this is an important bit that we need to take note of because 8,000, which I've written here as realized, would actually be the actual price in which we want reflected in our books. Okay, at $8,000. And 40% remained unsold. So when you see the word remaining unsold, straight away you need to identify where it's going to be located. So in this case, it's inventory. So inventory is the balance sheet item and it would be located in inventory of PICO's books because PICO is the company which owns the inventory. So this is of year end, and then 20% is the tax rate, which we should note when we are calculating our deferred tax asset. Okay, so intuitively, this is how I sort of approach the question to find out how much I need to change. So basically, my consolidation entries, the figures, I'm going to sort of figure it out through this column over here. So how much do I need to adjust my current entries in order to form to reflect what I have on a group level. Okay, so for the first line item, it will be sales. So ESCO transferred at 10K, so transfer price. So this is actually the TP here, 10K. And PICO's book is at 8K because that is their sale to third parties. Okay, so the total 18K. However, as a group, we are only going to record the 8K. It's an opportunity for you to see how much we need to reduce it by, and I'll reveal the answer later. For cost of sales, ESCO records at 7,000, which is the price they bought it at, right? 7,000 over here. So this is the original cost. And for the third party, for PICO, it would be how much they bought it at, and then it would be at 60% because 60% is what they sold. Okay, so that's 6,000 and the total would be 13K. And then I'll leave you to figure out how much we need to adjust it by. Next would be the tax expense. I'm not going to touch the gross profit because that bit is going to be reflective. We're not going to adjust the profit directly, but rather the other line items from which we derive the profit. So next will be tax expense. So we have 600, which is 20% of 3,000, and 400, which is 20% of 2,000. So we have 1,000 in total. And then for inventory, we have 4,000 because ESCO has sold everything. Okay, so now I will reveal the answers and we can see whether your adjusting entries are correct. Okay, so for sales, we need to reduce it by 10,000. okay, because it's too much at 18K, because the group only needs to record 8K, so we need to deduct it. Okay, and then cost of sales is 13K, so it's overstated, right? Again, so we need to add back 8,008. And tax expense again is once again is overstated, so we need to add back 240. Inventory, it's overstated because it should be at the original cost, and the original cost was 7,000. So 7K times the remaining is 2,800. So at 4,000 it's going to be overstated by 1,002, so we need to reduce our inventory account. And then for deferred tax asset, it is going to be 240. So that would be 20% of the inventory. So this one relates to this one. So because inventory reduces by 1,002, we're going to have a deferred tax asset of 240. Okay, so that's the end of example 1. And for the next video, we'll talk about the entries itself.